Unpopular opinion. Honestly, SCHD is really not that great. Here are 4 competitors that are clearly better, plus a bonus 5th that I choose over all of them. Let's get into it. Now, before you finish all your angry comments, let me be clear. I totally get the appeal of SCHD and there's nothing inherently wrong with it. But I think there are some objectively better alternatives out there. Now, for anyone who isn't familiar, in short, SCHD is an index fund that focuses on high quality US companies with higher yields than the S&P 500 and 10-year histories of paying dividends. That has tended to lead to a portfolio with lower volatility than the S&P and a healthy dividend yield, which has typically been in the 2.5 to 4% range over the past 10 years. But in a lot of ways, VIG, the Vanguard Dividend Appreciation ETF, DGRO, the iShares Core Dividend Growth ETF, LGLV, the SPDR, SPDR, SSGA US Large Cap Low Volatility ETF, and CGDV, the Capital Group Dividend Value ETF, are all better alternatives. Okay, so now I'll start at a high level, then get into a few of the specifics of each compared to SCHD. And finally, we'll get to the bonus ETF that I would prefer over all of them. Now, just like SCHD, all 4 of these alternatives are also US-based dividend ETFs. VIG, DGRO, and LGLV are all also passive. So let's start with those. All 3 have 10+ year histories of growing their dividends every year, just like SCHD. But all 3 have consistently beaten SCHD over the last 1, 3, 5, and 10 years. This is showing total return with dividends reinvested, by the way. Now, before you say, oh, Kyle, it's because they must be riskier. All 3 have also had consistently lower volatility than SCHD over the last 3, 5, and 10 years. And VIG is even cheaper at just 5 basis points versus 6 for SCHD. DGRO and LGLV aren't far behind at 8 and 12 basis points respectively. So in my opinion, all 3 are better alternatives to SCHD. But how'd you choose between them, and is there anything SCHD wins on? There is, so here's how I think about it. If you're all about the lowest cost possible, the Vanguard Dividend Appreciation ETF, VIG, is cheapest, and that will be the winner. In essence, VIG tracks an index that focuses on US companies with a history of consistently growing their dividends. For investors who care most about low volatility, LGLV, the SPDR, SSGA US Large Cap Low Volatility ETF would be the winner for me. The 5 and 10-year volatility has been close with VIG, and VIG has actually been lower over 10 years, but the last 3 years have not been as close, and LGLV is the only one that specifically targets lower volatility. It's not active, it's passive, and there's no guarantee that its rules-based approach will be the best at limiting downside risk in any particular downturn. But if I had to guess which one would be most likely to do that, it would be the one that focuses on it, which is LGLV. DGRO would be the best option if someone wanted to complement other more growth-oriented holdings like the S&P, NASDAQ, momentum ETFs, or anything like that. This chart shows SPY in light blue, SCHD in medium blue, and DGRO there in red. You can see that besides SCHD, which would be the best complement to growth-oriented strategies from a style perspective. The only other one that has been consistently value-oriented over the last 3 years has been DGRO. So if you still want that complementary nature from a style perspective, but in a strategy that has offered much better results and lower volatility than SCHD, DGRO might be the one for you. For investors who are willing to consider active, I prefer CGDV, the Capital Group Dividend Value ETF, over all 3 of these. Since its launch in 2022, it's beaten the pants off of all of them. Now, before you go and say we're cherry picking here, we actually introduced CGDV as an alternative and said we preferred it well over a year ago. And since then, it's crushed SCHD. Now, will it always beat SCHD this badly? No, probably not. But I think there's a good chance it will produce better results in the long run. What gives me confidence, despite its short track record, is that it's managed by Capital Group, which is sort of the king of dividend investing in the mutual fund world. Their US dividend-oriented funds like the American Funds Washington Mutual Investors Fund, Investment Company of America, and American Mutual Fund have long histories, all over 50 years, of beating the S&P 500 with lower volatility. And now that they're starting to offer some of their funds in more tax-efficient ETF wrappers, and at an extremely low cost like CGDV at only 33 basis points, it's time investors started paying attention. CGDV attempts to build a portfolio of US stocks that can produce an above average income for its investors and an opportunity for long-term growth. In a lot of ways, CGDV looks for similar types of companies to SCHD. Both focus on a diversified set of high-quality, dividend-paying companies I'd expect to generally lead to lower volatility and higher yield than the S&P 500 and most other value-oriented ETFs. Now, as for how to choose between them, here are what I think are the key differentiating factors. A key difference is that CGDV tries to provide an overall yield higher than the S&P 500, but not every company it holds has to have an above average yield, whereas they do in SCHD. That leads to three key differences. SCHD will typically have a higher yield. SCHD will tend to lean more value oriented, even though they're both in the value category. And CGDV will have more flexibility to adjust to different kinds of market environments. You can't buy past results, but that flexibility plus Capital Group's ridiculously strong track record in similar funds over the last 50 plus years makes CGDV an attractive alternative to SCHD and all the others for me. But there's one other one I would pick over all of these, and that's CGDG, the Capital Group Dividend Growers ETF. This one is newer, and it's not a direct comparison since it's global, but that's one of the main things I like about it. The last 15 years has been all about the US, but there are a lot of signs that could be changing. First of all, markets are cyclical. Sometimes US stocks do better, and sometimes non-US stocks do better. And usually these go in long, multi-year cycles, often around 10 years, give or take. The main drivers are usually which industries are leading and whether the dollar is strengthening or weakening. There are three reasons I think non-US stocks could make a comeback, which make CGDG's global flexibility particularly attractive right now. The dollar is likely to weaken, which would boost the returns of non-US equities, at least from the perspective of a US investor. And three reasons the dollar could weaken over the next few years are that, number one, a lot of European governments and China are doing more to support their own economies, which is a big change from the last few years, or really from the last few decades in the case of Europe. Number two, the US seems to be a bit constrained in how much it can do to support its economy because investors are fleeing dollar-based assets like treasury bonds due to fears that the deficit is getting out of hand. And number three, at least as of the time I'm filming this, the Trump administration is considering a few very significant and, in my opinion, ill-advised policies specifically designed to weaken the dollar. I do think they'd weaken the dollar, but probably only in the sense that they'd destroy investors' faith in US assets even further and cause a mass exodus from US investments. That would obviously be bad for US investments and good for non-US investments, in addition to weakening the dollar. The second reason non-US equities could make a comeback goes back to the shift in fiscal spending, a boost outside the US and a constraint in the US, which not only could support a weaker dollar, but also boost economic growth rates outside relative to the US. And third, a big driver in US versus non-US returns is the industries that are in favor because, of course, we have different types of companies in the US than they do outside the US. The last 10 years, tech has dominated everything as mobile phones and fast internet led to the rise of all kinds of internet-related businesses like cloud computing, e-commerce, and social media. And then more recently, the AI revolution gave a second boost to the Mag 7. Over 80% of the global tech stocks are in the US. So if tech is leading, that's a huge boost to US stocks versus non-US stocks. Ultra low interest rates also boosted the valuations for a lot of those high growth companies. But we don't have ultra low rates anymore, and there's literally never been a time in history where the highest returning sector over a 10-year period repeated that over the next 10 years. It's never happened. So will tech lead again the next 10 years? The odds are not in its favor. And if it doesn't, that's a much better environment for non-US stocks than we've been used to. So the main reason I like CGDG over the others is that it's global. And I think that could be a big advantage in the coming years. Another interesting wrinkle about CGDG is that it focuses specifically on dividend growers. It's only been around since 2023, but it comes from the same company as CGDV, which also has an excellent track record with its global dividend-oriented funds. So where does SCHD win? Yield. It's got a higher yield than the others, but here's why I don't think that should be a consideration. There's a better way to generate income from your investments in retirement. Now, if you've ever worked a commission-based job, it's stressful. It's great when it's great, but when you don't know how much your income is going to be each month, it makes it hard to plan out your spending and create a sustainable budget. Let's say you invested $1 million in SCHD 10 years ago. Here's what your monthly income would have been if you'd been relying on the dividends. Sure, it's growth over time, but quarter to quarter, it has frequently shifted around by thousands of dollars. Why subject yourself to that? In my opinion, it's better to reinvest the dividends and then set up a systematic withdrawal plan at your brokerage account. It takes about 2 minutes, and then you'll get a check for the same amount each month, creating a steady, predictable income stream like a regular paycheck from your investments. The other reason the dividend shouldn't matter is because ultimately, a dollar is a dollar, whether it came from a dividend or appreciation. If you have $1 in your account, you can create $1 of income. If you don't, you can't. Period. And all of these strategies, at least the US ones that are direct comparisons, have produced significantly better results than SCHD. That means there's significantly more income potential. Well, at least in the past, there has been. Past results aren't a guarantee of future results, but all of these have so consistently beaten SCHD for so long, even while taking pretty similar approaches, that if it were me, I'd rather invest in any of them. Not that SCHD isn't also a solid option, it's just not the amazing investment that the internet seems to think it is. Last thing here. If you look at the YouTube stats on our channel, only about 20% of you are actually subscribed to our channel, even though we're dropping professional level investment knowledge on this channel. So if you found value from this video, please hit the like button and also hit that subscribe button. And if you want direct access to my business partner, Ethan, and I, you can join our free Discord, which has over 500 members. Thanks for watching, and I'll see you in the next video.